Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are a wealth management firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, June 22nd, 2026 edition. Let's get started. Investment values fluctuate on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. Diamondback Financial is a long-only investment firm, which means we keep your money invested in the areas that we feel offer the best prospects for growth instead of trying to time the market. We focus exclusively on the traditional investments of stocks, bonds, and cash, so we analyze fluctuations in the stock market and in interest rates to help drive our overall investment decision process. So we start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. We saw a resumption of missile strikes in Iran at the beginning of the 2-week period. After Iran allegedly shot down one of our helicopters, we had a measured response. And for a couple days, we were bombing sites in Iran, and the market declined as a result. When we finally got a resolution and a peace deal or a ceasefire, the markets were able to recover. But again, we're still dealing with whether or not it's actually going to hold, and the stock market fluctuating, maintaining some volatility as a result of the headline risk of what's actually happening. We were able to close the 2-week period up 1.58%, and we have a year-to-date gain of 9.57. The stock market was closed on Friday for the Juneteenth holiday. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe interest rates really are the preeminent measure of investment risk. Rates are factored into every investment calculation, including stock valuations. Generally speaking, declining interest rates may lead to lower costs of doing business and higher earnings, which help drive stock prices higher. And increasing interest rates may lead to higher costs of doing business and lower earnings, which would drive stock prices lower. So thus, we typically say that lower interest rates will lead to higher stock prices and higher interest rates will lead to lower stock prices. We can also look at the spread for high yield corporate bonds to give us a glimpse into the probability of default for the companies that are using debt to finance their operations. For the last 2 weeks, we saw this, what we call a twist. Well, first, we've got interest rates listed over here on the y-axis, and we've got maturity lengths listed on the x-axis from 1 month all the way out to 30 years. Each of these dots represents an interest rate for a given maturity length. The green line is where we were on Thursday, the 18th, and the brown line is where we were 2 weeks ago. So we've seen what we call a twist in the yield curve, where the short-term rates have gone up over the past 2 weeks, and these medium to long-term rates have come down. This is also what we call a flattening of the yield curve, and is something that we'll be keeping an eye on. We've talked about this in the past, but usually when we see what's called an inverted yield curve, where the short-term rates are higher than the long-term rates, that's a phenomenon that typically happens prior to a recession. It's not 100%, and it doesn't necessarily tell us when or how long before a recession will occur. But we actually had an inverted yield curve from 2022 to 2024 with all the inflation and the Fed raising interest rates to try and bring inflation down. And so far, technically, we've been able to avoid a recession. So we're not necessarily predicting that we'll see an inverted yield curve anytime in the near future, but that is the direction that we're currently heading. The 10-year U.S. Treasury over the period of the last year, we can see that we've had it down closer to 4%. It peaked here about a month ago at 4.66, and has come down about 20-ish basis points to about 4.45. I remember hearing on the radio or hearing somewhere that the 30-year mortgage interest rates are the lowest they've been in the last month, which I guess I can believe, since the 10-year Treasury is very highly correlated with 30-year mortgage rates. For corporate bond spreads, we're seeing the amount of interest that these companies are paying above and beyond what the U.S. Treasury rates are back to the lowest we've seen in the last year, right? This is where we were prior to the war with Iran starting, and we're all the way back down to where we were there. So suggesting that there is a low probability of default in the corporate bond world. And at the moment, it feels like the stock market and the interest rate markets are telling us that things are looking positive. All right, for our expectations and implications portion, there's really only three stories that we felt like were significant enough to cover over the past 2 weeks. It was the end to the Iran war, or is it? The SpaceX IPO, initial public offering, and the first interest rate decision and press conference with the Federal Reserve's new chairman, Kevin Warsh. So we did get what we believe was a ceasefire, peace deal, intent to start negotiations on the end of this war on last weekend, which allowed the stock market to recover. It allowed oil prices to come down and allowed gas prices to come down and hopefully start setting up an opportunity for us to get back to the way things were prior to that war starting. So we've got oil prices that we have not been as low as we are now since the beginning of March, right in the early days of the bombing that we had in Iran. So hopefully we'll see this continue to come down again back into the $60 barrel range where we were prior, although it sounds like most people are expecting it'll remain in the 70 to 75 range, at least for several months. There were countries like China and others who were adding to their stockpiles, which was keeping the price of oil around the 60 range for the last six months or so. We've been depleting strategic petroleum reserves around the world that we need to replenish. So we've got enough demand for oil that we don't necessarily anticipate that the price of oil is going to come down back to the pre-war levels in our estimate by the end of the year, right? As long as we can replenish those stores. Gas prices back down below $4 on average, which is again not where we've seen gas prices since 3 months ago in March. It's still the summer driving season, and we still have limited refining capabilities, which we are anticipating the refining facilities will reduce some capacity so they can do the annual maintenance that they do on their facilities now. And we would like to see gas back down around $3 or less per gallon, but again, give it 3 to 6 months before we really start to see prices come all the way back down to that level. Again, this is all assuming that the Iran war is over, even though as we record, we're still seeing that Israel is fighting with Hezbollah in Lebanon, and Iran is threatening to keep the Strait of Hormuz closed until that fighting's over. There are some negotiations that are supposed to happen here tomorrow on Sunday. So as of the time of this recording, things are still up in the air. Hopefully by the time we send this out Monday morning, we have some more clarity on where things are going. Again, SpaceX IPO, if you haven't heard about it, initial public offerings are kind of a big deal. They're kind of fun. This is an opportunity for a company to be traded on the stock exchange and for us to become owners if that's something that we want to do. This was a big deal. This was the biggest initial public offering, the biggest IPO ever. And we saw some pretty significant changes in the stock price just in the week that it's been trading. It started out at $135 a share. That's what it opened at. It got all the way a little above $200 a share, but coming back down to about 185 here on Thursday. So it's interesting. Again, this is not a recommendation. Just this was a big story that we wanted to make sure we touched on. Finally, again, Kevin Warsh is the new chairman of the Federal Reserve. The Federal Reserve will set interest rate policy for very, very short-term interest rates, but that does have a reverberating effect through all the interest rates that are issued by the U.S. Treasury Department. So this chart is something that we've been sharing recently because we think it's helpful in explaining which direction we think interest rate policy is going to go. We have the Federal Reserve rate that they set is the white line that changes over time. We also have the 2-year U.S. Treasury rate that fluctuates over time as well. And this is a 25-year chart going back to the recession that we had in 2001. Right, these red bars represent recessions here in the United States. 2008, 2009 recession, as well as the COVID recession. So again, we typically see the Federal Reserve will raise interest rates to a point where they're trying to restrict the market rates, if you will, and keep the economy from growing too far too fast. And so once we get to a point where the Federal Reserve raises interest rates to a certain level, and then it flattens out and starts coming back down, that's generally what precedes a U.S. recession, right? Again, and that's kind of also plays into the inverted yield curve that we mentioned earlier. Now, there are times where we allow the 2-year Treasury to be significantly higher than the Federal Reserve rate. But generally speaking, we try to maintain some sense of equivalence, or eventually getting above to keep it from getting too far too fast. We're at a point right now where we were cutting interest rates, avoiding a recession, and things were looking like they were going to be set up for another interest rate cut. But then we had the Iran war, and ever since then, we've seen the 2-year Treasury go from 3.4 all the way up to nearly 4.2. Pretty significant reversal from the trend that we had been on. I pay for research from economists and people that I think are a lot smarter than I am, and they're all telling me that we're expecting the Federal Reserve to raise interest rates at least 0.25%, at least up to the 4% level that we were just at the end of last year. Some are saying that we're going to go, that this new chairman's going to raise them even higher. He's going to go 0.5% or even 0.75, again, to try and suppress the 2-year Treasury rate. So our base case, the analysis that we put in suggests that there's going to be no change to the interest rate policy between now and the end of the year. Now, again, I have to let you know that there are people that I think are smarter than me that are telling me that rates are probably going to be higher at the end of the year. So we'll just have to wait and see who's actually correct. But we're not expecting, if they do raise interest rates 0.25%, we're really not expecting that to be anything that would decimate the economy. We believe a lot of the inflation that we're seeing is due to higher oil and gas prices, the cost of doing business associated with the Iran war. So if we can get out of this war and we can get it to an end, and we can increase the supply of oil and gas and bring those costs down, that we would see the inflationary pressures come back down and the 2-year Treasury come back down below where the Fed funds rate is right now. So that's our base case. Obviously, things may change. We'll have a lot more economic data come out over the next 2 to 3 months that may change our opinion of where we think interest rates are going. But that's kind of where we're at for now. All right, as a final word, kind of like the Olympics, every 4 years we have this phenomenon called the World Cup. It's the biggest soccer tournament in the world where all these countries come together and they play each other and to see who's the biggest and best soccer team. I'm not a big soccer fan, but I have found myself watching almost every match, or at least having it on in the background while I do some work or I'm at home doing other things. So the U.S. team has done well. They're going to advance to the next round. And I guess, to try and tie this in, the reason I don't like soccer very much is because I find it very boring. I like when teams score a lot of goals or runs or points. And so basketball tends to be something that I enjoy more. Where soccer, you can basically have these guys run around for 90 minutes and score nothing. And it's hard for me to stay engaged during that entire process. So, there's some similarities in that regard with the stock market and with investing that, 90% of the time, there's not a lot that's going on that we have to worry about. And again, maybe depending on who's in the White House, things can be a little bit more interesting than not. But a lot of times it's just patience, right? You have to sit there and you have to strategize and you have to try and put yourself in a good position to score a goal. or to get some good growth out of an investment, and it may just take a little bit more time than you thought, but um, it can be pretty boring. So we try to come in and put in as much effort as we can, and then we just kind of let it go and let it accrue the interest or the growth over time, and just try to play a game of patience. And so the investment management side is only part of what we do. We also try and get the financial planning and the wealth management side of it. Make sure you've got uh, good people taking care of your taxes, good people taking care of estate planning and any insurance needs. And so if you have something that's financially related, that's not necessarily an investment question, and you want to pass it by us and see if there's something we can help you with, let us know. Otherwise, have a good couple of weeks, and we'll see you soon.